and gentlemen, please welcome on stage Zoe Knight, Managing Director and Global Head of Sustainability Research and Integration, HSBC. Moderator, Patricia Falco-Beccali, Co-founder, Falco Global Partners.
Wonderful. Thank you so much. We again had already the theme of finance. So money is really important. Money makes the world go round. And our fireside chat, Zoe, net zero financing gap. Mobilizing the capital to really finance our green energy transition. And if I think about the latest study, just to kind of lay the land a little bit, from the International Energy Agency again, we need $4 trillion globally, annually, by 2030, to be invested in order to get to our goal, and I have to repeat it again, of net zero by 2050. Why are we sitting here? Is the money not flowing? Is there a financing gap? Tell us a little bit how you see it right now.
We certainly are here needing to talk about financing this transition that the world is about to see. And thank you for hosting me, Baker Hughes, to join us all to talk about this conversation today. So first off, in the financing world, we have made some progress. So we know that we need to divert a lot of capital to providing solutions for energy transition. So what has the finance community done so far? Well, first off, we've created a new asset class of labeled products. So in the markets world, we have green bonds, sustainability-linked bonds, and all of these instruments have helped investors identify which projects are accretive to the net zero transition and has helped them show the impact that they're taking. And now that labeled product universe, as we know it today, is around almost 5 trillion. So there's a lot of liquidity for investors to look at today, but what we really need to do is mobilize more for the future.
Well, the interesting thing that financing green, you were saying, was pretty straightforward, plain vanilla. I think the first green bond was issued 2007 by the European Investment Bank, and it was actually sucked up by the market. Then what happened? Did we just have different asset classes jumping on it because investors were asking for it? Or what was really pushing it? The projects, the investors hoping for a good return, or the governments seeing that something needed to be done?
Well, it's interesting actually, because it's something slightly different in that if you think about what the finance community is good at, it's good at pricing risk and it's good at assessing returns, and on that basis it can make a decision about whether or not to invest in a project. So that was the history of how to think about energy projects and net zero outcomes. Increasingly, investors were pushed to talk about alignment with emissions pathways.
Yes.
Now, what on earth does that mean if you're an investor? Like, how do I go about taking a decision that aligns emissions curves to a net zero outcome? And so investors were challenged to think about this, which meant that the market sort of slowed down in terms of how to identify which projects were really helping countries meet their climate goals, which financing and decisions were helping corporates meet their net zero goals. And so we've seen a little bit of a speed bump in terms of how the finance community can talk about whether or not it's helping or hindering the transition. And really that's the kind of crux of what investors are mandated to do in many cases if they have a specific green, if they're mandated to run green money, they need to show that the outcomes that they're achieving are emissions on a downward curve as opposed to emissions on an upward curve. And that's really tricky.
It is very tricky because you have to look at the entire let's say, investment horizon, supply chain as well in that sense. Okay, so what are you investing in? Is it actually true? A lot of the debate is maybe the outcomes are being overstated, how green the investment really is. But I think in terms of the actual flow of funds and the road bump you were just mentioning is really regulation. So we do have regulation, which is good, gives transparency, disclosure act, very, very good. On the other hand, for us asset managers is an additional layer of red tape we have to adhere to. It's an additional risk if we should step wrong, we have a reputational risk. And for you, investor, does it actually add anything or are we being all confused? That's a big part of it too.
It's a really big part because in the beginning, investors were looking at a very simple in concept problem, i.e. emissions need to come down. You solve emissions by renewable energy up, energy efficiency up. The global context is easy to understand. As the green and labeled markets have become more sophisticated, investors want to look more at transition finance. So investors thought that more financial regulation would help provide clarity about what transition means. But in reality, it means we've gotten really tangled up because every country is coming from a different starting point in its energy position and its ability to shift at speed in terms of both political will, commercial viability of clean solutions, public appetite to make the change, technological capability and capacity, a whole variety of factors are making these local issues increasingly relevant for the transition picture and increasingly a picture that investors need to worry about. And so with the regulation, the tangledness of trying to solve for all of those issues is getting a bit in the way. And one thing that we did last year, actually, was run a survey among investors of whether they thought regulation, so financial regulation, was a help or a hindrance. And actually, it was 50-50, more or less. 50% thought, yeah, this is great, it gives us more guidance. And the other 50% thought, no, you know what, this is not helping us in the slightest because we need flexibility on our markets that we want to invest in coming from a different starting point.
I always think there's two sides to the story. There's us maybe delivering these kind of products to investors, and then there are our punters, the investors. So why they want to invest in something that eventually really has an impact and aids the transition and a green energy transition, they also want to make money. So let's talk a little bit about the return on investment and what sort of investor. What is the real DNA of an investor that goes only green or looks to really invest in that, but also make money?
Yeah. You see, that's another interesting question because we've seen waves of interest. And the first wave was all about asset managers that wanted to launch dedicated funds linked to outcomes, so the environmental agenda. But increasingly, we've seen the asset owners, so the sovereign wealth funds, getting more involved as a means to deliver on the country climate activities. So we all know that every year there's the Conference of the Parties linked to climate, where we talk about countries implementing their climate ambition and getting emissions down. Well, in many countries, the sovereign wealth funds are the key enablers of that. The sovereign wealth funds are mandating asset managers all around the world to look after their capital, and therefore they are deploying different criteria to each of their asset managers to deliver the returns. And so that creates a really different picture from the US to Europe to Asia in terms of how investors are thinking. But the crux of the matter is this trade-off, as you say, between risk and return and increasingly alignment. And that's where we've got this sort of speed bump. And that's why we think that, that some pragmatism from continent to continent, down to country is needed in order to unlock those capital flows that we so desperately need to see.
Again, that triggers in me the question is, if we do green and we invest in green on one part of the globe, but the other part doesn't play the same. So there's no level playing field. So whatever I do good, it might not be the same in the other part. How do we actually get to a level playing field, and how do sovereign wealth funds or other investors, be it private equity, venture capitalists, ultra-high net worth individuals, really play into the picture to get to a level playing field?
Yeah, this point is something that I feel like I've spoken about my entire career of looking at climate and finance.
Okay. Drill deep. Good.
And the answer is, again, it comes in waves. Sometimes it's the political agenda, sometimes it's the economic agenda, and sometimes it's the technology agenda. And what I think we're going to see going forward is more on the economic agenda, because the political agenda and the awareness around advocacy on policy, that era came around the Paris climate talks, COP21. It was, it's a while ago. Now the era is thinking about the economics and the technical capabilities and the ability to bring prices down so that the investment flows can be unlocked. And so what I expect to see is the economic thinking being more closely linked, whether that's in how to think about the green bond market and the sustainability-linked market, or whether or not economies are going to deliver on growth potential given the energy picture and how they're sourcing their energy needs.
Yeah, we run a private equity fund, and for us, ESG is a given. It's not a USP anymore. It's kind of like, oh, of course you do that. On the other hand, you always think, okay, does it really give me the internal rate of return? And I just happen to come over a little statistic. We have to talk numbers, I do. It is a finance panel anyway. It's like the LSE came out with a really interesting study looking at thousands of funds, about 5,000 funds, I think, having assets under management of 350 million. Little funds, really, in the growth things, investing purely into green products, and there the return on the internal return was 38%, with a multiple of 2.3. Mixed funds, compared to that, was an IRR of 18 and only 1.7. So green can be really green. So give us a little bit of a pitch. Why? And how would you mobilize, let's say, now the audience, to really, next time they invest, be it privately, be it also, proprietary trading books of their companies or assets in general, why they should go green, and why there is not only the good in it, but the good in it?
So, in many ways, it's impossible not to go green, because going green is about the future of the economy and the future of the energy system and the future of countries to be able to stay competitive. And this is the critical factor, competitiveness, in a world where the different dynamics of power are ebbing and flowing. New entrants through the sovereign wealth funds are coming to the market. And the product opportunity is becoming increasingly great, and we've heard of some of that through the kind of AI consumer channels as well. So it's a matter of being fit for purpose to generate the returns of the future by looking at green today, and it's unavoidable, because if as an investor you're not thinking about how those future trends play out, then you get left behind, and then you lose mandates, and then and then. So it's a win-win.
It's a win-win. So looking ahead, do we really get to that 4 trillion a year that green energy needs in investment?
So the thing that I should say is it's going to come from a variety of sources, right? It's going to come from corporate cash flows, as well as funds, as well as private credit, as well as traditional lending, which might not be labeled, the labeled fixed income market, the equity market. The whole financial ecosystem is part of providing the funding for the transition that we need to see. What we will see is a variety of the increasingly labeled products are still with us. We're expecting supply to increase between 5 and 10% for green, 7% for sustainability linked. So the market's growing, and it's about where your appetite sits within that market to be able to get access to the returns that you want to see.
And where's the appetite, you think?
Good question.
No answer. Great stuff. Thank you so much, Zoe.
Thank you.
Thank you.